good afternoon. So much question mark about how much tariff, when, what's going to happen. How does the Indian investor maintain their sanity?
Well, I think clearly the starting point is that yes, we remain in a long-term uptrend, a long-term bull market. In along the way, we will have many speed breakers or roadblocks that you would call them. And we've seen some of this happen at the start of the year. We saw even sometime in April, May, when we had the geopolitical conflict. Around that time also, there were concerns. Similarly, I think this time around, the imposition of this tariffs clearly, I think, is a sentiment dampener in the very, very short term. But I don't think this affects the prospects of the Indian economy or for corporate India in any significant or material way. If at all, this adversity will create an opportunity or many more opportunities for us. So I clearly think that from a medium to long term perspective, I think investors ought to keep the faith, ought to keep the confidence on the upside potential that India as an economy and corporate India has to offer. So clearly, I think one should look at this as basically a buy on dips opportunity.
And you think in the short term, the market will give you that opportunity? It will dip further, or the market is already priced in the worst case scenario of 25% or not?
Well, it looks like that market has to some extent, priced this in. Keep in mind that our markets made a high sometime last year, sometime in 2024, around September, October is when we made a high. And after that, it's been almost now about 9 to 10 months that we have gone in through a time-wise consolidation, partly because of the valuations that we were trading at, or partly because of some of the issues around tariffs or around the geopolitical conflict. So I clearly believe that a fair bit of the time-wise consolidation has happened. We could probably continue to be in kind of a range-bound market for maybe another few more months or so. But that's about it. I clearly believe that this is really the kind of time to kind of step in out there and continue to buy into high quality names. So I clearly think market has offered an opportunity. It is continuing to offer an opportunity, and maybe this opportunity time window could probably still be there for another few more weeks or few more months. But clearly, I think the outlook from a 12-month perspective or from a 2 to 3 year perspective is continues to be very, very strong, continues to be very, very robust.
And I think that's the larger question, right, Nilesh, that do you now need to redefine and relook at what is quality? Because if I just pick up the banking set of earnings, even there have been casualties from large private banks too. It's a case of high provisioning pretty much across the board. Do you sense that one has to also rework what you call quality now? And clearly the entire tariff tirade has made you rethink all of that.
So, Aisha, I think the banking sector faces a unique set of challenges, and I'm talking largely for the larger banks, because while they continue to be very strong franchises, but they continue to have a lot of competition. And again, from an asset quality point of view, we probably peaked out about 4 quarters or 6 quarters away. And right now they are basically grappling with the asset quality issues bouncing off from an extremely favorable base. So that's one challenge, number one. The second big challenge is competition. I think they are getting challenged by non-bank lenders, they're getting challenged by fintechs, by specialized credit plays. There is ample amount of liquidity out there, which is to some extent taking away the sheen of pricing power from the big banks. So they have dual problems. One is basically that they are coming off from a very favorable base on asset quality, and two is essentially there are challenges in terms of their margins. And so net, they probably will grow in high single digit to maybe low double digits. But that's about it. But I think one has to kind of look beyond the obvious top 4 or 5 banks and look at maybe some of the smaller banks, look at fintechs, look at some of the other online distribution plays, which are basically selling credit, selling insurance, selling investment, selling mutual funds. So I think the whole financials related ecosystem itself has changed. The investment canvas or the investment landscape has changed, and we now have a much broader, diverse set of companies or business to really pick and choose from. So I think investors need to necessarily not just be focused on the obvious top 4 or 5 banks or the top 4 or 5 insurance companies, but to look at really the next level of players and to look at the other kind of players which can kind of give you proxy exposure to that same space, but are growing at a much, much faster pace.
Yeah, you've often talked about while big banks will continue to do well, specialized credit plays, HFCs, NBFCs are going to do well. But Nilesh, for someone with limited capital, what within this very large umbrella can one tap into, and what's looking like the meatiest investment right now?
So Aisha, I think clearly the winners of today, the winners of tomorrow, the challengers of today, and the champions of tomorrow will continue to be companies which embrace technology. I think technology is the only way by which you can create relevance to a very large and a growing mass of the middle class. So whether you are a bank, whether you are an affordable housing finance company, whether you are a mutual fund company, whether you are a platform selling insurance or selling mutual funds or selling investment products or selling equity products, unless you don't have an online strategy, I think your chances of winning are going to be very, very limited. I clearly believe that embracing technology is going to be the starting point of you establishing or defining your right to win. So clearly, I think from our point of view, we've really been more focused on trying to own companies which have created technology platforms to offer consumer products, to offer consumer services, to offer financial products and financial services. I think that to me has to be really the core for maybe the next 3 to 5 years. I think that's one very, very interesting pocket. Going beyond, the consumer and the financial names, I believe again on the manufacturing side, on the capital goods side, on defense, aerospace, indigenization, that again is a very, very powerful basket to really pick and choose from. So I think two sets. One is the B2C businesses powered by technology, and on the other hand are some of the B2B businesses where your cost effectiveness and your products, your capabilities in terms of products are really defining your future. So I probably think that these are the two big, big opportunities that investors ought to be focused on.
Nilesh, if I were to draw any correlation between what's happening at a global level and what's happening here in India, look at the Super Bowl of earnings that we've had in the US. AI, tech, that clearly dominates the leadership, the weightage, and everything that comes with it when it comes to the US markets. Can you really draw that same comparison here? And do you think the tech sector, I'm not talking about IT services, but tech can evolve or at least can perceive to get higher valuation than where some of these companies are right now?
So I should all depends on what we define as tech, but just a differentiation between how the US markets are or US economy is versus Indian markets and the Indian economy. The US economy and the US markets are already kind of pretty much been a developed market for maybe the last 50 to 100 years. We are still a developing economy. And so clearly, I think the set of opportunities are very different. The kind of businesses that are there are very, very different. So what worked in the US probably 30, 40, 50 years ago is probably working in India right now. And so to that extent, I think one has to look at it from that thing. We still don't have an adequate universe of technology creators. We have an adequate universe of technology embracers or technology providers, but not technology creators. But that's perfectly fine. If the United States has its own Metas and Googles who are using AI to kind of grow at a hyper pace, we too have our hyperscalers. I mean, when we kind of look at some of these capital market plays, when we look at some of these consumer internet platforms, we clearly seeing that kind of growth. I mean, the second largest online travel aggregator. I mean, and these are companies, just a disclaimer that we own them. they have grown at 60-70%. Our quick commerce companies are growing at 60-70%. Our online insurance distribution companies are growing at 30-40%. So we have our own set of hyperscalers. And to that extent, therefore, I think these are the kind of companies that we need to continue to kind of evaluate, and which I think we should be positive about owning them. So I think the two markets are different, the two economies are different. It's just that we don't necessarily need to look out for those technology creators. We have enough of these companies which have created some very sound, robust technology platforms in the world of consumer or in the world of financial services. And I think that's what we should be focused on.
So you're saying that's still focused on the consumption-driven economy with a flavor of tech, right?
Absolutely. I mean, Aisha, look at it. I think some of the most powerful things that are going for India are our demographics and our urbanization and the digitization. The younger population is using technology to buy products, to buy services, to buy financial products. That continues to be a hugely secular structural growth opportunity, where the opportunity is very large, penetration is very low, and therefore the runway of growth is quite phenomenal for a very extended period of time.
You're still of the belief that there's no compelling reason to be in large cap IT services, that is?
Yeah, absolutely, Ash. I mean, look at it. The last decade has been fantastic for the world of technology, right? And even in a decade like the last 10 years, our top 4, 5 IT services companies have probably grown at 8 to 10% in INR terms. If you kind of peel away the depreciation of the currency, and then you take away the inorganic growth, the growth has been at best probably mid-single digit. This is when so much has basically happened in the world of technology. I think that our challenge is we mistake them for being technology companies or technology product companies, but they're technology services companies. So they are a services company whose growth will be broadly in line with the growth of the US economy or the growth of the European economy. So to that extent, I think even in a great environment, they've grown at about 4 to 5%. I probably think that should essentially be the realistic kind of expectations from them. And so I think if you're really looking out for those equity kind of returns, probably that's not the place to be. Yes, of course, if you're following a very large cap strategy, you're basically hugging benchmarks, then maybe, yes, as a very large allocator, you can probably think about them. But I think for bottom up individual investors, I probably think that may not necessarily be the best place from a 3 to 5 year perspective. In the very short term, maybe from a 3 months, 5 months perspective, you could probably get those trading rallies in them and make some money. But otherwise, I think probably from a medium to long term perspective, I probably think India market offers you better growth opportunities.
Sure. So I just want to pull in consumption with tech because there's lots that is tech driven now, right, Nilesh? And we've talked about it for many months that we've chatted. I mean, you buy the BBC products online, you plan your holidays online, you bank online, you buy insurance online now. And I could go on adding to that list. Plan, travel, tourism, just everything online. What's looking like the meatiest and maybe lesser tapped pool than completely untapped?
So Asha, I think there are many kinds of opportunities. And like, for example, last evening, I mean, one of the fast growing alcobev companies, they came up with their quarterly results, and they grew their revenues probably at about 30%. So I think you have these kind of categories which are growing. So of course, travel is charting its own growth trajectory. Quick commerce is charting its own growth trajectory. Food delivery continues to grow in high teens. And then you have some of these bunch of alcobev companies also which are growing at this kind of pace. So I still think that yes, we need to necessarily move on from the conventional staples to kind of more the discretionary spends. And really be more focused on those kind of businesses. And like some of the names, some of the categories that we've already talked about, be it alcobev, be it beauty, personal care, and personal hygiene, or be it travel, be it food delivery, quick commerce, these are some of the categories which still continue to grow at a very healthy and a robust double digit. And so I think we need to really be more focused on that kind of spending rather than just necessarily looking at the very conventional stuff of soaps and shampoos.
Yeah, absolutely. Uh, Nilesh, the other pocket that you've always liked, defense. Now, with defense, I don't think there is a debate about indigenization of the entire defense manufacturing. It's more about what price are you willing to pay for some of these defense names. They're the first to go off when the market's correct, and that's where you can pick up the first signs, perhaps, of the market getting overheated. Do you think one should not really be too bothered about the price and should have defense names at whatever price, even if little, as part of one's core portfolio?
Aisha, defense has become now high beta, undoubtedly. They basically, I think, in a risk-on environment, they tend to kind of move up quite massively, and in a risk-off environment, they do tend to kind of basically also kind of trend lower as well. I believe that in high beta spaces, I think one should just be a little bit more patient and wait for those opportunities or those air pockets where you get the opportunity to buy in at slightly lower prices. The challenge with defense is that while, of course, the opportunity need not be debated, or the size of the scale of the opportunity need not be debated, but I think in the very near term, I don't think, their order books are kind of swelling or bulging. And you clearly seen for some of these companies how the June quarter has been tepid, especially in the context of how their stock prices have behaved between the lows of March and the highs of June. So I would probably advise a little bit of caution. You will get opportunity maybe over the course of next few months to really buy into them. But when that opportunity comes, I think one should essentially be in defense, because clearly defense has become a national imperative. Indigenization has become a kind of a strategic imperative. And so to that extent, there is the whole opportunity driven by indigenization. And two is, if essentially we get our the global opportunity right, like for example the European Union has announced that they're going to spend about 5% of their GDP on defense, which means that this is going to create opportunities for our defense companies as well. So I clearly believe that one should remain very optimistic and constructive on that. Just that, wait for probably the right opportunity, let there be some bit of cool off. That is really the time to step in.
So you're saying be cognizant of valuations, don't be blind about it.
Yeah, absolutely. I mean, I don't think so, because otherwise, or maybe yes, you can start nibbling there if you don't have any exposure, but keep some ammunition dry. That when the opportunity comes in, you will have the ability to strike.
Would you say that about the rest of the market as well? If in the near term we were to be headed lower, keep some powder dry?
Yeah, I think one should always keep some powder dry. I mean, how much powder dry is obviously more for individuals to decide, or individual investors to decide. But I think this is an environment which continues to be very volatile. It's not necessarily a very easy environment to be in. While we have many tailwinds of growth, but obviously there are some set of global challenges which probably are just are a little uncontrollable. So I think it might just be advisable to keep some powder so that whenever we get these opportunities, one feels very comfortable of participating in them.
Nilesh, structurally, if I look at it, I have no doubt about pharma or healthcare. Our demographics is young right now. We will get to aging population at some point. Market is a forward-looking beast. That's the next pool. If you look at leadership, if you look at stocks at all-time high, most of the healthcare names you'll find in that list. But right now is that whole niggling worry about what's going to play out on tariffs, whether medicines are going to be cheaper, whether they're going to be much more expensive, what happens to the generics pool. What's the thought on pharma right now? How should investors look at it?
I would still prefer the domestic pharma opportunity, the domestic healthcare opportunity versus the global opportunity. I think no matter what it is, but when it comes to essentially the global opportunity, yes, the demand for our pharma products, our generics are quite kind of non-discretionary in the sense that no matter what it is, it's going to hard to be for any of these big players or big markets to create alternative manufacturing capabilities. So I think India clearly stands out as manufacturing capability. But nevertheless, there are plenty of these regulatory roadblocks, if I may say, be it product specific approvals or be it the tariffs. So my view is that we've seen some bit of run up already happen. I would advise caution in that space for now, right now, and be more focused on the domestic healthcare opportunity, be it pharma companies selling medicines in India, or be it our own chain of hospitals, or be it essentially our own health insurance companies, or be it our own online distribution platforms, which are basically distributing health insurance as products. To me, that's a much more risk adjusted and a growth opportunity versus essentially the global pharma opportunity.
So, Nilesh, in your observation of how this earnings season is panning out, what the commentary from most managements are, where do you think the next profit pool is getting created?
So what has come out from this earnings pool is that the big companies, the big large cap companies still, I think, find the environment very challenging. I think they're finding it difficult to grow because because of their own size. I mean, they themselves are so huge right now that they are finding it very difficult to essentially grow in double digits. Of course, they've been growing in single digits, but they're finding it very, very difficult to grow in double digits. So that's partly because of their own size. And two is obviously the challenges that they are facing from their smaller set of competitors who are way more agile, way more fleet-footed. So I think that's really the problem which the larger companies are facing. And therefore, they're basically now confined to growing in single digits. But when I kind of look at the profit pools, I think one has to look for basically companies which are able to grow in double digit way in a very capital efficient manner. And I earlier talked about some of these consumer companies, the financial services companies, which are using technology to create platforms and reach out. So I think that still remains a very, very interesting pool of growth and of earnings. So that's one. Two is clearly, I think we have seen some of the energy equipment companies report some very, very strong growth. We saw a couple of publicly listed multinational companies, which over the last 2 to 3 days have come out with some stellar performance. We own one of them, but they've come up with some really strong, solid performance. Companies which are more focused on the distribution space, distribution of energy, transmission of energy. So these are companies which are dealing in the world of HVDC. They have come up with some very, very strong performance. So I think that's a very interesting profit pool. And maybe, Aisha, if I were to kind of look at maybe 4 quarters from now, 6 quarters from now, I think the defense companies or the companies which are into aerospace, I think they'll come back with a bang in terms of their revenue growth or in terms of their earnings growth. I think as the orders start to come in, so one should clearly also watch out for that space in terms of an emerging profit pool.
Interesting. Nilesh, are you not in India?
I am in India. I'm pretty much in my office.
Okay. Friday look then.
Yes,
But
it is
good.
a Friday look. Sorry, this was already scheduled. I'd already
No,
set for office.
absolutely.
Uh,
But good having you on the show. Thanks as always for your time.